All right, good morning, everyone. Happy rainy Tuesday. Thank you so much for joining us on our discussion today surrounding the 990 tax return for nonprofits. My name is Courtney Clement. I am one of the audit managers here at Lauterbach and Amen. I am joined by my colleague, Jack Carney, who is one of our senior tax accountants. Both of us work very closely with various nonprofit entities and are really looking forward to this discussion. We will be hosting a Q&A session at the end of this presentation. If you look at the bottom of your screen, you will see the Q&A box that you can type your questions into. We will also be monitoring the Q&A box throughout the presentation and are happy to answer questions as they arise. This session will also be recorded and posted on our website under the News tab by the end of this week, in case you want to share this information with any of your staff or just want a little bit of an overview of what we discussed. To give a brief overview on what our discussion will consist of, we'll chat about filing requirements, due dates, extensions, Schedule B and Schedule A, unrelated business income, change in accounting period, audit requirements, and key pieces of the tax return. So now I'll kick it over to Jack to get things started.
Thanks, Courtney. Big role of our tax department is the 990 practice and preparing 990 returns. I'm in charge of preparing most of them within our department. But with that said, I also do many other forms of tax as well. And the 990 return is by far the most detailed and informational tax return that is out there. Not in the sense of calculating tax liability or shareholder basis, because that's not applicable to 990s, but the devil is in the details with this tax return. And because it's informational, the IRS is looking very closely at not only the number side to see if that all looks legit, but also the other informational pieces that I'd really like to shed a lot of light on during this presentation. So with that being said, who is required to file? These would be your tax-exempt organizations, non-exempt charitable trusts, as well as Section 527 political organizations. So before we really get into some of the nitty-gritty items with the 990, some of the filing requirements, pretty standard. Exempt organizations are required to file annual returns just like any other entity. If they don't file or file late, the IRS may assess penalties. Late filing penalty is $20 per day with accruing interest. So we definitely want to make sure that all returns are filed on time or extensions are filed on time. If an organization does not file, for 3 consecutive years, it will automatically lose the tax exempt status, which is worst case scenario. Definitely don't want that to happen. Starting for tax years in 2020, paper filing is no longer allowed, and electronic filing is now mandatory for all tax exempt entities. Returns filed on paper will be returned. Now, this may not seem like a very big deal. However, I'd like to give an example of a client that we had changed its accounting period. The IRS it wasn't within the IRS's system. So when we went to e-file the return, it rejected it automatically because our software didn't line up with what was in the IRS system. So we paper filed, not having any other option. A few months later, the IRS comes back and returns the return to the organization saying, we only accept e-file. It's a juxtaposition in that how are we supposed to kind of file this return if we can't paper file it by, alerting them that the entity has changed its accounting period. Now, I'm going to go into that a little bit more in later slides, but it does create some unintended consequences with this e-filing strict requirement. And this is unique to tax-exempt organizations. No other entities are required to only e-file. They can paper file. So this is a bit unique. And then, within the requirements, who can sign the return? We get this question a lot. People will say, oh, our executive director is out of town. We can't, sign until they get back next week. Well, any officer can sign the return. It can be the treasurer, secretary, vice president. That part doesn't matter. It can be any officer, not any board member, but it can be any officer. So just like to clarify that because we do see that question come up quite a bit. Moving on to due dates and extensions. These are very important. Starting with the state of Illinois, this will be due 6 months after the fiscal year end. Illinois allows 2 60-day extensions. On the second extension, we're required to file the $15 filing fee. One note here I'd like to mention is the AG office, they're processing the returns before the extensions when they receive them. So what's happening with a handful of clients is that they're receiving unwarranted notices because the state is seeing a return that was accepted after the due date, but since they haven't processed the extension, they haven't seen that. So some of these notices are going out automatically. Nothing to worry about, but I think something worth mentioning. On the federal side of things, the return is due 4.5 months after the fiscal year end, and you're granted 1 6-month extension. I'd like to just visualize this real quick because the due dates can get very tricky with different fiscal year ends and due dates and things of that nature. So let's take, for example, a December 31st year end. The federal return is going to be due on May 15th, or the extension is due May 15th. Let's say extension is filed. That is a 6-month extension, meaning that will be due on November 15th. For the state, the original first return or extension is now due on June 30th. If you file an extension, that's going to be due on August 31st. And then the second extension, if it needs to be filed, is due on October 31st. So in my opinion, the timing is a little bit weird with the way that Illinois does it because the second extension is due before the first extension is due on the federal. It's just very important that we all stay on top of these due dates and all the extensions because Illinois likes to complicate things, as we all know. Moving on from the due dates, the different types of 990s. There are really 3 main types of 990s. The most simple is called the 990N. This is where gross receipts are going to be less than $50,000. And I would like to just emphasize this is gross receipts, not net income. We've gotten questions where clients will say, well, our net income is $5,000. Can we file 990N? Well, unfortunately, no, this is a gross receipts test. If gross receipts are under 50,000, the 990N is a very simple return. It's basically just a checkbox saying receipts are less than 50,000 and one of the officers needs to sign the return. It's pretty simple. We then have the 990EZ. This is where the gross receipts are going to be less than $200,000 and total assets are less than $500,000. The name kind of says it all. It's easy. There are far less questions than the typical 990. There are fewer pages, fewer supplemental schedules. It's a much more simplified version of the traditional 990. And then moving on, by far the most common type of return that we will see is the typical traditional 990. I won't read through those thresholds there, but this is the return that we're going to talk mostly about today, and most clients will be filing this return. So my goal today is not to go through the 990 page by page and go through every single schedule because that would take 4 hours. and everybody would probably be asleep by the end of it. Instead, I really want to shed light on some of the most important pieces of the informational return that we have here. And so this is on page 6, section B. These are a list of questions regarding the kind of the internal processes of the organization. And I'd like to point out at the very top, it says section B requests information about policies not required by the Internal Revenue Code. That I think that's almost kind of funny. It's kind of like when your high school sports coach tells you that practice is not required over the weekend. Well, yeah, maybe it's not, but it really is. I'm going to read through all of these questions here because they're incredibly important to the way that the organization runs and operates. And if these questions are consistently being answered no, that's a huge red flag, and that it completely opens the door to an IRS audit. So I'm going to read through these questions really line by line, 11 through 15. We want as many of these to be answered yes as possible. It's extremely important, and it's really something that gets looked over, I think. When I'm preparing a lot of these 990s, I see these questions answered no really more often than not. So starting with number 11, has the organization provided a complete copy of this form to all members of its governing body before filing the form? Number 12, did the organization have a written conflict of interest policy? Did the organization have a written whistleblower policy? Did the organization have a written document retention and destruction policy? Did the process of determining compensation of the following persons include a review and approval by independent persons, comparable data, and contemporaneous substantiation of the deliberation and decision? And finally, 16. 16 is actually not, it's not a required yes to be, so we'll skip over that one. But I just want to really drive home the point that these 4 or 5 questions here, we really want them to be answered yes, because these are really internal controls that the organization really should have. Okay, moving on to the Schedule A. After that, page 6, section B, we're going to go through the rest of the 9. So it goes through the board of directors, statement of net position, functional expenses, balance sheet, all that good stuff. And then we get to the supplemental schedules. And this starts with the Schedule A. And the Schedule A is one of the most important and easily the most overlooked schedule that we have on the 990. I think we tend to think that the supplemental schedules are a little bit less important because, well, everything else is filled out on the main form. These are all kind of just additional forms that aren't important. That's not true. The Schedule A is one of the most important parts of the 990. The purpose of it is to provide information about the public charity status and the public support of the tax-exempt entity. This is how it will distinguish itself as a public charity and not a private foundation. So I'm going to go through an example here. Most, but not all nonprofits are going to select the box 10 on page 1 of the Schedule A. And this is an organization that receives more than 33 1/3% of its support from contributions, membership fees, and gross receipts from activities related to its exempt function. And going on to the next page here. So assuming box 10 is selected on part 1, part 3 should be completed. And so part 3, the gifts, grants, and contributions and program service revenues count towards the public support calculation. So public support is calculated and reported on line 15, which on the next slide, I'm going to walk through that. And this is the most important line on the schedule, line 15. In order to meet the public support test, the percentage of public support, it must be greater than 33 1/3%. It basically, we want to show the IRS that the exempt organization is receiving more than 33 and a third percent of its revenue from public support, not getting it from unrelated business income or interest and other investments. It's a huge thing that we want to keep an eye on. So moving on to the actual Schedule A. So this is just an example here. It covers a 5-year time period. And what it will do, Section A takes the public support from the return. It compares it to Section B, the total support. And as you can see at the very bottom on line 15, public support percentage is basically almost 90%, 89.89%. That's a great number to be at. That's not going to raise any red flags with the IRS. This is showing that the entity is receiving mainly donations, membership fees, things that are all related to its tax exempt function. And moving on, this is really a great transition from the Schedule A to unrelated business income. Unrelated business income would be reported on the Section B portion of Schedule A. It's really a big part of, it's a big thing to keep an eye on, because even though an organization is recognized as tax exempt, it still may be liable for tax on its unrelated business income. So for most organizations, the unrelated business income is going to be income from a trade or business regularly carried on that is not substantially related to the charitable, educational, or other purpose that is the basis of the organization's exemption. So if there's more than $1,000 of unrelated business income, then we're going to be required to file the Form 990T. So I'd like to just give a quick example of unrelated business income, because this question does come up quite a bit, and what it is and how does it work. So there was a client that we had a few years ago that we saw they provided special needs to children, and they had almost kind of a day camp, and it was a place for them to go after school and work on things with, you know, different teachers and everything. And attached to this building was a cafe, and within the cafe they would sell different drinks, beverages to parents that were waiting and other visitors. And there was also merchandise being sold within this cafe. What we found out was that this actually triggers an unrelated business income liability, because the sale of merchandise like t-shirts and the sales within the cafe were unrelated and not substantially related to the purpose of this organization. And so what happened was they ended up filing, you know, the 990T on this unrelated business income. And it's just an interesting circumstance that we came across. And I don't mean to open another can of worms, but they also acquired a sales tax liability on top of all of these, on top of the unrelated business income as well. So it really is important to keep an eye on what is regularly carried on and what is really kind of going towards the purpose of the organization and what is not. So business activity, as I said earlier, of an MPO are regularly conducted if they're frequent and continuous and are pursued in a manner like comparable commercial activities of a for-profit organization. Some basic examples of UBI that I just want to kind of touch on would be collecting rent, advertising income, selling merchandise such as apparel or t-shirts. Some exclusions from UBI that I have here listed on the slides would be dividends, interest, annuities, other payments such as loan repayments, anything of that nature would not be considered unrelated business income. I just want to reiterate the unrelated business income is more indirect revenues that are regularly carried on in the normal course of business. Okay, and so if we have anyone out there who does think that they may have some unrelated business income, please let us know, and we're happy to do some research on that and look into that a little bit further. The change in accounting period, this has been a big question that we've seen over this past year with clients on how to change it. What are the requirements? Are there any forms that need to be filed? An organization may change its accounting period by filing a return for the short tax period that results from the change. So a short tax period is an accounting period of less than 12 months, and it usually occurs when the organization starts operations or it changes its accounting period. When this happens for the first time, all that we need to do is simply write change in accounting period at the very top of the short period return. The following return is going to cover the full accounting period for the new accounting period. So we've seen this with a handful of clients now. The one area where I could see this being a problem with the IRS is with the e-filing requirement, because since we are required to e-file all of the returns moving forward, how are we supposed to literally write on the return change in accounting period? We're supposed to just submit this straight through the software into the IRS's system. There's going to have to be some sort of resolution between maybe the software department or the IRS, but in a vacuum, the simplest way is to write change in accounting period. But I could see a potential problem with that, just in the way that with the e-filing requirement. So before I hand over the remaining portion of the presentation to Courtney, I just thought I'd ask if we have any questions out there relating to any of these topics. And if not, I'm happy to pass it to Courtney.
All right, thanks, Jack. I'm going to move on to kind of talking about audit requirements for nonprofits and how it relates to the tax return and items that Jack just discussed. So for the state of Illinois, an audit is required for a nonprofit organization if one of the following has occurred in the fiscal year. The first is if gross revenues are in excess of $300,000. Please note that this is gross revenues, not netted against expenses. So total contributions received or donations in the year exceeds $300,000. Or if the nonprofit paid a professional fundraiser and the fundraiser that was performed raised contributions in excess of $25,000. So in most cases, we do see the $300,000 mark. So I definitely would keep that in the back of your mind if you're a nonprofit that may or may not be reaching that threshold, or you think an audit may be required for the state. Obviously, an audit can be conducted at any threshold, but it's not really required with the state until you hit that $300,000 mark. Some key pieces of the tax return and the audit. First, with the program service accomplishments section. I know a lot of you that I've worked with in the past, I talk a lot about program service accomplishments and how important they are to your tax return. This is essentially the part of the return where the foundation has the opportunity to explain their tax exempt purpose and really what they're formed for, like what are they actually doing. Part 3 of the 990 tax return asks for the 3 largest program service accomplishments as measured by expenses. We want to assure that these programs are explained in as much detail as possible. This return is not financially driven. Really, overall, the tax return isn't really financially driven, as Jack mentioned, but this piece in particular is narrative in nature. So it really gives you the opportunity to explain the programs that you put on during the year and how it relates to your tax exempt purpose. It's the easiest piece of the return for readers and outside donors to understand and comprehend. Additionally, part 7 of the return shows a list of key personnel and board members. Please note that these individuals should be the year of the return, not the current year as the tax return is being filed, essentially 1 year in arrears. As Jack mentioned, any current officer can sign the return if they had the chance to review it. You don't necessarily have to go back to the old board president or the old treasurer to get their signature if they are no longer on the board. I do see a question, but we will save that for the end. So I do see your question and we will get to that to the end of the presentation. The next piece I wanted to talk about was the statement of functional expenses. It's a very important piece of the tax return and of the audit report. Essentially, there are 3 buckets that all expenses should be allocated to: management in general, program services, and fundraising. Management in general would include oversight, business management, general record keeping, really anything that's not directly related to the conduct of program services or fundraising activities. So program services and fundraising activities are pretty easy to drop the expenses into and kind of understand what that means. But management in general can get a little tricky. They really should not be the largest percentage of expenses. It would be anticipated that the nonprofit would have a majority of their expenses in program services, since essentially that's what they're formed for. They do have their tax exempt purpose, and really what they put on throughout the year would be considered their program service accomplishments. This statement is not required to be separate in the audit report. There's nothing saying that the functional expenses has to be a separate statement altogether, but it does have to be included in the audit report, whether or not it's included within the statement of net position or it's its own separate statement. I next wanted to talk about in-kind donations, which are also known as gifts in kind. They are donations of goods or services to the foundation that the foundation did not need to pay for. In most cases, in-kind donations should be recorded on the income statement. It would be a debit to in-kind expense and a credit to in-kind revenue. So essentially it would be a wash on the income statement. However, in-kind services that are not specialized in nature do not need to be recorded on the income statement. So the example I always like to give is related to attorneys. So if an attorney provides pro bono legal expense to the foundation, they don't get paid, they provide their attorney services, it must be recorded on the income statement. However, if that same attorney goes and volunteers at a 5K or a specific program of the foundation, it's really just noted in the disclosures of the financial statements. So it doesn't have to be recorded in the income statement. What we see most commonly with our foundations of park districts is that park district employees will essentially volunteer to do the accounting for the foundation. So the foundation won't pay the park district employees. Really, it's kind of out of the goodness of their heart to help and do the accounting for the foundation. So in that case, we would measure and estimate how many hours they would have spent on the foundation, and that would be recorded in the income statement. And as far as in-kind donations go with the tax return, there is a little bit of differences here. Donated goods are recorded as revenue on the return, but donated services and use of facilities are not. So you will see total goods and services in kind in the income statement in the audit report, but as it relates to the tax return, donated services and use of facilities are not recorded as revenue, and they are a reconciling item on Schedule D. So that is a caveat and a difference that you'll see between the two. All right. So with all that being said, we would like to open the floor to Q&A, and we also wanted to provide our contact information in case anybody had any specific questions related to their foundation. So we'll let the Q&A box kind of sit for a little bit if anybody has a couple questions and would like to hop into the discussion. I have a question here that I am going to have to kind of get back to you on. The question is, are sales proceeds for the sale of investments included in the $300,000 measurement? I have an idea of how I want to answer that, but I don't want to give you the wrong answer. So I will take note of that and I will get back to you on that. Anybody else have any other questions? And of course, if anything does come up at the conclusion of our presentation, feel free to shoot myself or Jack an email. Like I said, we have a lot of nonprofit clients that we work with directly, and we're always happy to assist if anything else comes up. But with all that being said, thank you so much for joining us for this webinar. I hope that you learned a little bit about the 990 tax return and audit. Have a fantastic rest of your day. And again, if you have any questions, feel free to reach out to myself or Jack. Take care.